Welcome to Power Charting. I am your host, Bruce Fraser, and we are going to talk about inflation, probably the most important issue for investors, traders, savers, consumers of this decade. And we have seen an incredible surge of inflation in recent months, and it's been very sudden, very extreme. Can there be a case made for inflation moderation from these very extreme levels? We're going to attempt to do that today. It is a cautionary tale because of the impacts of inflation on investors. Can these inflation trends moderate? Is it going to be a meaningful moderation? And will the inflation return back down to the more normal levels that we saw prior, as was originally said, it was transitory? We think not, but let's have a look at that. And then, can stocks rally after yesterday's Fed decision to raise a quarter point, and then their outlook for the future? So this CPI chart is using classic horizontal point figure analysis to be able to determine a potential for how high inflation can go. Well, lo and behold, if we just take this first level right here, we can see that inflation has reached a level of the first count right here. And this is 8.25 to 11.88. The low end of this count range is 8.25. And as of February, we were at 7.9. Now, they have changed the way CPI is calculated over the course of the years. And so the changing of this may actually mean that the inflation might be somewhat higher than the 7.9 number, which would be baked into these count objectives because of the older calculation methodology. Difficult to determine this, but that's okay. We'll be able to see that there's basically a potential objective in this range. Could go up to 11.88, could happen. So let's just keep in mind that inflation continues to bump higher. There is a larger count that goes as high, incredibly, as 19%. And let's just hope that never comes into play, because we see here that CPI is a tax on income and savings. And it's also a capital tax on savings and investor retirement accounts, et cetera. And this really informs the job ahead for investors, because investors are going to need to maintain purchasing power. This is going to be a huge discussion point issue for us to deal with here in power charting in the weeks and months ahead. And I'm already thinking about programs that we can do where we can address this issue with the intention of trying to develop ideas, concepts that we could employ in portfolio management to be able to do that very thing, maintain purchasing power, maintain standards of living, and then also for savers to be able to just maintain their savings rate. So with that in mind, this chart here is really quite remarkable. And this chart is the Nasdaq 100 index, the very large cap growth stocks, in a relative strength ratio to the Commodities Research Bureau index. And the CRB is a collection of commodities that are an index like other indexes, say stocks, et cetera, representing a number of different areas of commodities. And this is a log scale chart. And incredibly, this rise in the relative strength of Nasdaq 100 stocks over the last 9 years is been a remarkable juggernaut of appreciation of stocks relative to commodities. This makes stocks here overvalued relative to undervalued commodities. And note into the COVID event in early 2020, there was a climactic Biden climax surge, which took out the top of this large trading channel of rising prices, which was formed back in 2011 and 2014. And then after that, a classic distribution form, meaning that Nasdaq 100 stocks, which is a surrogate for all stocks, was distributing relative to commodities, meaning commodities were being accumulated. This is a rotation, and it's a rotation away from stocks towards real assets. And then after a distribution formed, a attempt to hold this demand trend line with a rally here in late 21, then completely broke down. And we've had a substantial decline in Nasdaq 100 stocks relative to the commodity index. This tells you that commodities are now outperforming and are likely to do so into the foreseeable future. Well, the CO types, the composite operator types, the large super savvy institutions were participating in this, were rotating their capital away from these expensive stocks into value commodities. And this is likely to go on. This trend is just beginning. As you can see, this trend was just beginning back here. And we want to keep that in mind always as we go forward. And I would add this consideration too. What is it that causes inflation? Is it because too many dollars are chasing too few goods, sort of a classic definition of inflation? I think it's because of speculation. I think speculation into these commodity markets, because there's been so much money that has been made, and QE and all these other forces have drawn money into the stock market. Well, now all of this latent wealth that's been created there is migrating away from stocks and choosing rather to speculate in commodities rather than speculate in stocks. And so I believe a big part of what can create underlying inflation pressures is pure speculation. That's just my view. And I believe that this can go on and on and on from here. And investors will say, I can just do so much better trading these undervalued commodities than these overvalued stocks. And as long as that goes on, you're going to see pressure on inflation. I'm not making a very good case for inflation moderation, but stick with me. So here we're looking at the yield curve. And the yield curve is very important, because when the yield curve gets flattened, gets down to zero, that's a point at which you get a slowdown in the economy, often resulting in some kind of a recession. Well, this here is a very steep flattening of the yield curve. It went from steep to flat. Now, it's not negative yet, where shorter term yields are higher than longer term yields, but we're getting very close. Yesterday on the Fed's decision, the 5-year yield on treasuries went above the 10-year yield on treasuries, at least momentarily. Here, we're looking at the 2s to 10s. And back, we originally made this chart, as you may recall, back in 2018, 2019, because we had a flat yield curve. I made the case at that time, no big deal, because the backdrop was, yes, the yield curve was flat, which wasn't going to result in a recession because yields on both the 2s and the 10s were falling. That is not the case today. As we can see from these two arrows, interest rates are rising in literally the whole yield curve. The whole yield curve is going up, but the short end of the yield curve is going up faster than the long end, which creates the flattening effect. So the flattened yield curve, now roughly 20 basis points on the 2s, 10s, is very close to zero, but it doesn't need to go negative to have a profound impact on the economy. And this is a measure of tightening action, tightening monetary conditions in the economy. This chart on the left over here is all important because this is what we like to look at, which is the point figure analysis. How high can 10-year yields go? Well, there is a base that's been built here, and we can count that accumulation structure. Here is the resistance line at around 2%, 195, and this count, which this was as of February 8th, is now at roughly 2.19. And so just as a reference point, it's right there, but the count or the objective goes 2.6 to 3.2% on the 10-year. Well, this is very consistent with the Fed's saying about the risk-free rate, is they want to get up to about 2.8. That's sort of their target range, so to speak, the high end. And it could very well be that the short end, the Fed funds rate, gets up to the level of the 10-year when this is all said and done, because the yield curve is flat or flattening. So this chart, this count makes total sense. So the target potentially still can go from 2.2 to 3.2 on the 10-year yield. Now, this has the effect of slowing the economy, moderating inflation pressures, potentially bringing down CPI. Another thing we can look at here is the crude oil chart. This chart on the left is a count that I did back into the COVID period of 2020. And this was a accumulation count. My experience is crude oil is really good on point figure on accumulation and distribution counts. Look at how well this count worked out here. So this count across goes to 85 to 212.5 roughly. This area here, this is November 21, went right to that 85 level and stalled, and then had a very sharp break down to the bottom of the channel. And there, then it began to rally again. So that 85 level was all important. We showed this chart to you 2 weeks ago, 2 power charting sessions ago, and we said at the time that we had a throw over and an overbought condition and a buying climax, and that buying climax went into the area, actually went through the 112.50 level and had a spike up through it. Well, interestingly, right then and there, it went through, and then let me erase these. And now I want you to just pay attention to the chart on the right, because I'm going to bring it up to date. And you can see on the chart on the right that it went 2 days above the 112.50 level, spiked at around 127, 130. So it went all the way through. But the key to a point and figure chart is, especially on a climactic run, is that it often will go through the top of the objective range, but can it hold up there? And typically they can't, because it's exhausted its potential. And in fact, that's just what happened. 2 days it spent above the objective range of 112.50, the high end, and then failed quite dramatically back down. And notice what we said at the time, is we said we needed to have, we had a climactic surge, extreme volume, the point figure counts were fulfilled, and that we wanted to see an automatic reaction to confirm. Well, we got that automatic reaction right here. And now we are, I believe, in some kind of a range-bound condition in here, building a cause for potentially another move up, potentially a move down. We may have more weakness. We're still have been weak in here. We might be able to go into the channel before being able to build a cause. And this could take months and months and months. Another form of potential moderation on the CPI index would be for crude oil prices to be able to stall and potentially decline further into the channel. So there's another thing that could positively influence moderating CPI numbers. Here's the dollar. This chart I made in August of 21, and here you see a 7-year uptrending channel substantially wide in this this uptrend in the dollar index, and it came down in August of 21. I made this chart and said this touch of that lower end, that demand line of the trend channel, would likely produce a rally in the dollar. And so let's see what in fact happened. Here is that chart updated through yesterday. Here is the level that we were just looking at, and a point and figure chart stands out to us on this dollar index here, and this count takes us up to the level of, as well, let's just say as high as 28. And so that's those two green arrows here in this area, 28, which is also that extreme bar that we had. That's roughly the area of the close of that bar. And so the dollar, again, is strong. The dollar continues to be a reserve currency. It is a place to hide. It's a place for the world to come and protect their capital, their wealth, and that's what happens in times of trouble, is that the dollar becomes a safe haven. There is talk about having other reserve currencies for crude oil purchases, etc. But I believe that this chart says that that is not in our immediate future. Maybe down the road, but for the time being, the dollar still is the important reserve currency of the world. A strong dollar tends to moderate the cost of imports. This is another area where if the dollar keeps rising, it could actually reduce the cost of goods and services that we buy from overseas. And that is also another form of moderation on CPI. So here's another thing that could help us for at least some period of time. Let's shift gears a little bit and talk about gold. A couple of interesting charts I want to bring up to date. This is the monthly bar chart on top of gold. You've seen this in the past, and I have often talked about this reaccumulation structure. That tiny little structure is about 18 months of sideways trading. We've returned back to the resistance that was set over here in 2011. And this takes us back to this count 192,202 on the GLD. Now this is gold up here, not the continuous contract, not GLD, but they have family resemblances. They're very similar and in their counts, etc. And so this middle count here goes 240 to 250. Keep that number in mind as we go forward. But the one thing I've not done for you is to count this area, this 18-month reaccumulation that is now up against resistance, and try to get a count. Well, I have a dear friend who I collaborate with and have for the last about 35 years, a fellow Wycoffian. We're, you know, a little community. I encourage you to find your Wycoffian friends, get on Zoom, meet with them in a coffee shop, share charts, help each other, learn from each other. That is what we have been doing for 35 years, and it's been absolutely wonderful. He's allowed me to show you this chart here, and so I'm very grateful for this. This shows a count of, in the accumulation here, of 2780 on gold continuous contracts. And here, this 18-month period that we have looked at up here, this count goes up to 2752. They are confirming counts. When they begin to reach confirmation, this often is a timing tool for the beginning of a new trend. So we're into resistance. We're very close to breaking out of this very large structure that goes all the way back to 2011. And if we do break that out, gold could become a great value investment with a trending characteristic. So let me take you to another concept. Tavi Costa, great analyst, has tweeted this chart, and I appreciate being able to put this chart up, but this chart is a ETF percent of gold, precious metals to ETF assets, all ETF assets, and it's 2.5%. 2011, it was at 14.5%. So precious metals are very, very small asset class relative to all ETFs at this time, which in my mind, and I believe that this is what Tavi Costa is saying, is that precious metals are inexpensive at this place. So now let's put up this chart on the right. This is the XAU to gold. XAU is a gold and silver miners index, Philadelphia Gold and Silver Miners Index. This is a relative strength point and figure chart of gold miners to gold. And this is the gold futures. And notice this structure: preliminary support, selling climax, automatic rally, secondary test, sign of strength, LPS. So classic Wyckoff structure. Let's remove this. This produces a beautiful count structure here across this area. And now let's take that count. Let's just do the most conservative count that we can here. And this count is just this zone right down here. And what does that count to? Counts to 126, 136 from a level of around 80 at this time. Now remember, this is relative strength. So what this is suggesting, it's saying that gold shares as a percentage of gold prices is going to appreciate, is going to dominate the performance of even gold. So gold miners are going to outperform gold, whether they both go up together, whether they go down together. Gold is going to be gold miners are going to be the better assets to own. Okay, so we have 2.5 minutes left. Let's just really quickly cover the stock market. Fear and greed is currently at 13. Extreme, well, it's not currently, it was on March 7th. And that put a reading of under 20. Extreme fear, extreme pessimism. Sentiment is an environmental indicator. It's not a perfect timing indicator. The put call ratio also very extreme on a 10-day moving average basis. Extreme pessimism, a lot of put buying. This sets up an environment for a potential rally in stocks. You've seen this chart before. This simply says that we have fulfilled the downside count, a conservative, smaller count here, and it could be that there's a bigger distribution count out in the future. But in the Qs, we have been getting very good counts on this one box reversal method, and we fulfilled the down count. That sets up the condition for a rally. And here we can see that we have just retested that prior low. We've had 2 really good up days on volume, and we can see the cues breaking the downtrend of its stride. And I believe that we are in some kind of a range-bound condition here, and that we have to do more work, build a further cause. But let me just show you one other thing. Again, on the NDX, you can see the climbing above that downward stride there. And in the 45 seconds we have left, here's the S&P on the left. I've taken a point and figure count of that same structure. You can see here that we've just marginally broken above the downtrend on the point and figure. This is 3-box method, daily data, 25-point scale. And we have a count here. Let's just focus on the near-term count. Goes up to 46.25. Well, look at this. It's roughly right at the level of that resistance. Slightly above it would be very common to do that. I still believe we're in a range-bound condition, but we could rally up to the top of the trading range. And with that, I'll thank you. I'll say goodbye. See you next time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.